Everyone told me to hold. My portfolio tracker flagged them as stable. 3 different finance forums I follow called them bulletproof. And yet this morning, June 29th, 2026, I sold every single share of some of the most popular dividend stocks in my portfolio. Not trimmed, not rebalanced, sold completely. And before you close this video thinking I have lost my mind, give me 8 minutes. Because what I found when I went deeper into these numbers genuinely unsettled me, and I think it is going to unsettle you too. Let me start with something most dividend investors never actually do. They look at the yield number and they stop. A 4.8% yield appears on the screen and the brain immediately relaxes. Safe, reliable, income generating. The word dividend itself has this psychological weight that shuts down critical thinking faster than almost any other word in finance. It sounds responsible, it sounds like something your grandfather would approve of. And that comfort, that automatic sense of safety, is precisely the mechanism that has been quietly trapping a generation of income investors into underperforming portfolios they will not fully understand until it is too late. Here is what a yield number actually tells you. It tells you the ratio of the annual dividend payment to the current share price. That is it. That is the entire calculation. It tells you nothing about whether that payment is growing, shrinking, or being held together with accounting tape and optimistic forward projections. A company with stagnant revenue can maintain a 4% yield for years, right up until the moment it cannot. And in the current 2026 fiscal environment, with margin compression hitting legacy businesses harder than any period in the last decade, that moment is arriving faster than most dividend investors are positioned for. The specific problem I kept running into when I went line by line through the financials of these household names was this. Revenue is not growing, earnings per share growth has flattened almost completely, and yet the dividend payment is being maintained or even slightly increased. On the surface that reads as commitment to shareholders. Go one layer deeper, and what you are actually seeing is a payout ratio quietly creeping upward. These companies are paying out a larger and larger percentage of their earnings as dividends, not because they are generating more cash, but because their earnings base is shrinking, and they are too afraid of the market reaction to cut the payment. That is not strength. That is a company spending down its future to protect its image in the present. Take legacy retail as a category. These are the names that dominated every dividend aristocrat list for 15 consecutive years. Consistent payers, long histories, the kind of companies that anchored income portfolios across millions of retirement accounts. But look at what has happened to their physical retail footprint costs, their inventory carrying expenses, and their inability to generate meaningful e-commerce margin against pure play competitors who do not carry the legacy cost structure these companies are buried under. The dividend yield looks attractive precisely because the share price has quietly drifted downward over 18 months. That is called a yield illusion. The number looks bigger because the denominator got smaller, not because the business got stronger. Utilities are a similar story right now, and this one hurts to say because utilities have been the bedrock of conservative income investing. But the capital expenditure requirements for grid modernization, the regulatory pressure on rate increases, and the rising cost of debt refinancing in the current rate environment have created a situation where several legacy utility names are generating free cash flow that is genuinely insufficient to cover their dividend commitments without drawing on debt or asset sales. They are borrowing to pay you. Read that sentence again. Some of these companies are effectively taking on new debt obligations to fund the quarterly check they send you and framing it as financial stability. The payout ratio is the number I kept coming back to across all of these positions when a company is paying out above 85% of its earnings. And in some of these names, we are looking at ratios above 90%. There is no cushion. There is no retained earnings buffer to invest back into the business. These are not income machines. They are income machines running on fumes while showing you a very clean dashboard. And this is the part that most finance content will not say directly. The market has not fully priced this in yet. Because the dividend keeps getting paid on schedule every quarter, the signal that everything is fine keeps firing. Retail investors keep reinvesting. But underneath the surface, the fundamental business trajectory and the dividend obligation are on a collision course. That the payout ratio mathematics have been telegraphing for at least 6 quarters if you know where to look. I am not telling you these companies are going to zero. I am not predicting a dramatic collapse. What I am telling you is that the risk to yield ratio on these positions no longer makes sense when I compare them side by side with what I have found. 3 alternatives with lower current yields but meaningfully superior revenue growth trajectories, lower payout ratios that leave room for actual dividend growth, and business models that are structurally aligned with where capital is flowing in 2026. The 3 replacements I am moving into, and I will break down the full financial case for each one in the next video, share one thing in common that none of my sold positions had. Their dividends are growing because their earnings are growing, not maintained, not stretched, actually expanding. A 3.1% yield that grows 12% annually will outpace a locked 4.8% yield within 4 years and leave it completely behind within 7. Over the timeline, most income investors are actually operating on 10, 15, 20 years. The compounding difference is the difference between a retirement portfolio that works and one that quietly disappoints. I made the move this morning. The capital is reallocated, and if you want to see exactly where it went and why, every number, every ratio, every specific company, that breakdown is coming. But before that video goes up, I want to know something from you in the comments below.